A Random Walk Down Wall Street, Disc 8.
2. Avoid overtrading. Behavioral finance specialists have found that investors tend to be overconfident in their judgments and invariably do too much trading for their own financial well-being. Many investors move from stock to stock, or from mutual fund to mutual fund, as if they were selecting and discarding cards in a game of gin rummy. Investors accomplish nothing from this behavior except to incur large transactions costs and to pay more in taxes. Short-term gains are taxed at regular income tax rates. The buy and hold investor defers any tax payments on the gains and may avoid taxes completely if stocks are held until distributed as part of one's estate. Remember the advice of the legendary investor Warren Buffett. Lethargy bordering on sloth remains the best investment style. The correct holding period for the stock market is forever. The cost of overtrading is quite substantial. Using data on the trading behavior of approximately 66,000 households during the period 1991 to 1996, Barber and Odine found that the average household in the sample earned an annual return of 16.4%, while the market returned 17.9%. In contrast, the annual return to the portfolio of households that traded the most was only 11.4%. In other words, the portfolios of those households that traded the most substantially underperformed more passive benchmarks. In addition, men tended to be more overconfident and trade far more frequently than women. Odine's advice to investors: if you are contemplating making a stock trade and you are married, ask your wife if you should do it. 3. If you do trade, sell losers, not winners. We've seen that people are far more distressed at taking losses than they are overjoyed at realizing gains. Thus, paradoxically, investors might take greater risks to avoid losses than they would to achieve equivalent gains. Moreover, investors are likely to avoid selling stocks or mutual funds that went down in order to avoid the realization of a loss and the necessity of admitting that they made a mistake. On the other hand, investors are generally willing to discard their winners because that enables them to enjoy the success of being correct. Sometimes it's sensible to hold on to a stock that has declined during a market meltdown, especially if you have reason to believe the company is still successful. Moreover, you would suffer double the regret if you sold it and the stock subsequently went up. But it makes no sense to hold on to losing stocks such as Enron and WorldCom because of the mistaken belief that if you don't sell, you've not taken a loss. A paper loss is just as real as a realized loss. The decision not to sell is exactly the same as the decision to buy the stock at the current price. Moreover, if you own the stock in a taxable account, selling allows you to take a tax loss, and the government will help cushion the blow by lowering the amount of your taxes. Selling your winners will add to your tax burden. 4. Other stupid investor tricks. Be wary of new issues. Do you think you can make lots of money by getting in on the ground floor of the initial public offering or IPO of a company just coming to market? Particularly during the great internet bubble that collapsed in 2000. It seemed that IPOs were the sure path to riches. Some successful IPOs began trading at 2, 3, and in one case, even 7 times the price at which they were first offered to the public. No wonder some investors came to believe that getting in on an IPO was the easiest way to coin money in the stock market. My advice is that you should not buy IPOs at their initial offering price, and that you should never buy an IPO just after it begins trading at prices that are generally higher than the IPO price. Historically, IPOs have been a bad deal. In measuring all IPOs 5 years after their initial issuance, researchers have found that IPOs underperform the total stock market by about 4 percentage points per year. The poor performance starts about 6 months after the issue is sold. 6 months is generally set as the lockup period where insiders are prohibited from selling stock to the public. Once that constraint is lifted, the price of the stock often tanks. The investment results are even poorer for individual investors. You will never be allowed to buy the really good IPOs at the initial offering price. The hot IPOs are snapped up by the big institutional investors or the very best wealthy clients of the underwriting firm. If your broker calls to say that IPO shares will be available for you, you can bet that the new issue is a dog. Only if the brokerage firm is unable to sell the shares to the big institutions and the best individual clients will you be offered a chance to buy at the initial offering price. Hence, it will systematically turn out that you'll be buying only the poorest of the new issues. There is no money-losing strategy I am aware of that is more likely to be hazardous to your wealth, except perhaps the horse races or the gaming tables of Las Vegas. Stay cool to hot tips. We've all heard the stories. Your Uncle Gene knows about a diamond mine in Zaire that's a guaranteed winner. Please remember that a mine is usually a hole in the ground with a liar standing in front of it. Your cousin's sister-in-law Gertrude was told confidentially about an undiscovered little biotech company. It's a screaming bargain. It's selling at only $1 a share, and they're ready to announce a cure for cancer. Think, for $2,000 you can buy 2,000 shares. Tips come at you from all fronts: friends, relatives, the telephone, even the internet. Don't go there. Steer clear of any hot tips. They are overwhelmingly likely to be the poorest investments of your life. And remember, never buy anything from someone who is out of breath. Distrust foolproof schemes. You will be told by amateurs and professionals alike that schemes exist to pick the best fund managers and to keep you out of the market when prices are falling. The sad fact is that it can't be done. Sure, there are portfolio strategies that, in hindsight, produced above-average returns, but they all self-destruct over time. There are even market timing strategies that have been successful for years and even decades. In the long run, though, I agree with Bernard Baruch, a legendary investor of the early 20th century, who said, "Market timing can only be accomplished by liars." And Jack Bogle, a legend of the late 20th century, has remarked, "I do not know of anybody who has done it, market timing, successfully and consistently." Does behavioral finance teach ways to beat the market? Some behavioralists believe that the systematic errors of investors can provide opportunities for unemotional, rational investors to beat the market. They believe that irrational trading creates predictable stock market patterns that can be exploited by wise investors. For example, the overconfidence of traders might lead to growth stocks being consistently overpriced relative to value stocks. These ideas are far more controversial than the lessons provided above, and we will examine them in the next chapter. Chapter 11. Potshots at the efficient market theory and why they miss. From an advertisement in the Financial Times, "The Clairvoyant Society of London will not meet Tuesday because of unforeseen circumstances." During a 3-week period in July of 2002, the Dow Jones average of 30 industrial stocks fell 1,500 points, from 9,250 to 7,750, a decline of over 16%. In surveying the carnage, financial reporters were quick to point out that it wasn't quite as bad as it was 15 years earlier, in October 1987, when the Dow lost approximately 1/3 of its value in a single month. This is efficient? To many observers and shocked investors, these events blatantly expose the failings of the efficient market theory. Did the stock market really accurately reflect all relevant information about stocks and the economy in early October 1987 or early July 2002? Had fundamental information about the economic prospects of major U.S. corporations changed enough to justify such rapid declines in the value of the Dow? Critics believe that such events stretch the credibility of the efficient market theory beyond the breaking point. The financial press has been unambiguous in its judgment. Just after the crash of 1987, the Wall Street Journal opined that the efficient market theory was the most remarkable error in the history of economic theory. A bit later, Business Week described the theory as a failure. Certainly the behavioral theorists whose work was described in Chapter 10 are highly skeptical that markets are efficient. The behavioralists chide their efficient market brethren for blindly accepting that the stock market behaves rationally. Robert Shiller concluded from a longer history of stock market fluctuations that stock prices show far too much variability to be explained by an efficient market theory of pricing, and that one must look to behavioral considerations and to crowd psychology to explain the actual process of price determination in the stock market. Often these characteristics can lead to predictable patterns of stock price movements and can be used by savvy investors to implement successful investment strategies, or so behavioralists like Robert Thaler argue. The work of the behavioralists has been buttressed by a large number of statistical studies that confirmed several predictable patterns of stock prices. Indeed, the new mantra in the academic community is that the stock market is at least partially predictable. One of the brightest of the new wave of financial economists, Andrew Lo of the Massachusetts Institute of Technology, published a book in the late 1990s entitled A Non-Random Walk Down Wall Street. And in What Works on Wall Street, James O'Shaughnessy, a money manager with a statistical bent, documents a large number of investment strategies that he believes have beaten the market and can be depended on to continue to do so in the years ahead. That's what this chapter is about. The attempts to show that the market, as demonstrated above, is not efficient and that there's no such thing as a profitable random walk through it. I will review all the recent research proclaiming the demise of the efficient market theory and purporting to show that market prices are, in fact, predictable. My conclusion is that such obituaries are greatly exaggerated and that the extent to which the stock market is usefully predictable has been vastly overstated. And then, when all is said and done, I will show that following the tenets of the efficient market theory, that is, buying and holding a broad-based market index fund, is still the only game in town. Although the market may not always be rational in the short run, it always is over the long haul. That, plus the fact that no one, or no technique, can consistently predict the future, represents to me, and I hope to you, a resounding confirmation of the efficient market approach. What do we mean by saying markets are efficient? At the outset, it's important to review what I mean by the term efficient. I'd like to relate it to a well-known story about a finance professor and a student who came across a $100 bill lying on the ground. As the student stops to pick it up, the professor says, "Don't bother. If it were really a $100 bill, it wouldn't be there." The story well illustrates what financial economists usually mean when they say that markets are efficient. Markets can be efficient even if they sometimes make egregious errors in valuation, as was certainly true during the 1999, early 2000 Internet bubble. Markets can be efficient even if many market participants are quite irrational. Markets can be efficient even if stock prices exhibit greater volatility than can apparently be explained by fundamentals such as earnings and dividends. Many of us economists who believe in efficiency do so because we view markets as amazingly successful devices for reflecting new information rapidly and, for the most part, accurately. Above all, we believe that financial markets are efficient because they don't allow investors to earn above-average returns without accepting above-average risks. In short, we believe that $100 bills are not lying around for the taking, either by the professional or the amateur investor. While some people agree that there are no $100 bills lying around, an even greater number insist that there's still lots of loose change. The debate on just how much loose change there is and whether there's any dependable way to pick it up is a subject that has made many academic careers. For the record, here's what I hold to be true, a conviction that has only grown more steadfast over time. No one can consistently predict either the direction of the stock market or the relative attractiveness of individual stocks, and thus no one can consistently obtain better overall returns than the market. And while there are undoubtedly profitable trading opportunities that occasionally appear, these are quickly wiped out once they become known. No one person or institution has yet to produce a long-term consistent record of finding money-making, risk-adjusted individual stock trading opportunities, particularly if they pay taxes and incur transactions costs. I put it more colorfully in the first edition of my book when I wrote that a blindfolded chimpanzee throwing darts at the Wall Street Journal could select a portfolio that would do just as well as the experts. Of course, the advice was not literally to throw darts, but instead to throw a towel over the stock pages. That is, to buy a broad-based index fund that simply bought and held all the stocks in the market and that charged very low expenses. I am more convinced than ever of the wisdom of that advice, and I am persuaded that those who take pot shots at the market's random walk inevitably miss their target. Or, to put it another way, the efficient market theory is quite efficient at dodging slings and arrows. Pot shots that completely miss the target. Some attempts to discredit the unpredictability of the market are so ridiculous that perhaps they should earn the sobriquet of greater fool theories. Among these are the Super Bowl and the hemline indicators, both described in Chapter 6. Under close examination, other picturesque potshots also misfire completely. These include the dogs of the Dow, the January effect, the thank God it's Monday afternoon pattern, and the hot news response. Dogs of the Dow. This interesting strategy became popular during the mid-1990s. It capitalized on a general contrarian style of investing consistent with the idea that out-of-favor stocks eventually tend to reverse direction. The strategy entailed buying each year the 10 stocks in the Dow Jones 30 Stock Industrial Average that had the highest dividend yields. The idea was that these 10 stocks were the most out of favor, so they typically had low price-earnings multiples and low price-to-book value ratios as well. The theory is attributed to a money manager named Michael O'Higgins, who published the technique in his book Beating the Dow, published in 1991. James O'Shaughnessy tested the theory as far back as the 1920s. He found that the dogs of the Dow had beaten the overall index by about 2 to 3 percentage points per year, and argued that the strategy had not involved any additional risk. The canine contingent of Wall Street analysts raised their ears and brought to market a large number of mutual funds based on the principle. By the mid-1990s, more than $20 billion of investment fund dollars were placed in dogs of the Dow funds sold by such prestigious firms as Morgan Stanley, Dean Witter, and Merrill Lynch. And then, just as might be expected, success bit the dogs. The dogs of the Dow consistently underperformed the overall market during the last half of the 1990s. As the dog star, Michael O'Higgins, opined, the strategy became too popular and ultimately self-destructed. The dogs of the Dow no longer hunt. January effect. A number of researchers have found that January has been a very unusual month for stock market returns. Stock market returns have tended to be especially high during the first 2 weeks of January. The effect appears to be particularly strong for smaller firms. Even after adjusting for risk, small firms appear to offer investors abnormally generous returns, with the excess returns largely produced during the first few days of the year. Such an effect has also been documented for several foreign stock markets. This led to the publication of one book with the provocative title, The Incredible January Effect. Investors, and especially stockbrokers, with visions of large commissions dancing around in their heads, designed strategies to capitalize on this anomaly believed to be so dependable. One possible explanation for a January effect is that tax effects are at work. Some investors may sell securities at the end of the calendar year to establish capital losses for income tax purposes. If this selling pressure depresses stock prices, it would seem reasonable that the bounce back during the first week in January could create abnormal returns during that period. Although this effect could be applicable for all stocks, it would be larger for small firms because stocks of small companies are more volatile and less likely to be in the portfolios of tax-exempt institutional investors and pension funds. One might suppose that traders would take advantage of any excess returns during this period. Unfortunately, however, the transactions costs of trading in the stocks of small companies are substantially higher than those for larger companies because of the higher bid-ask spreads, and there appears to be no way a commission-paying ordinary investor could exploit this anomaly. Moreover, the effect is not dependable in each year. In other words, the January loose change costs too much to pick up, and in some years it turns out to be a mirage. Thank God it's Monday afternoon pattern. Another predictable pattern, suggesting that a walk down Wall Street may not be perfectly random, is the so-called weekend effect. Negative average stock returns from the close of trading on Friday to the close of trading on Monday. In other words, there is some justification for the expression Blue Monday on Wall Street. According to this line of thinking, you should buy your stocks on Monday afternoon at the close, not on Friday afternoon or Monday morning, when they tend to be selling at slightly higher prices. Again, however, the effect is small relative to the transactions cost involved to exploit it, and it is not dependable from week to week. Hot news response. Skeptics of the inherent unpredictability of the market often point to the fact that the market is simply incapable of quickly absorbing information and then automatically repricing itself in response. Some academics believe that stock prices underreact to news events and that, therefore, purchasing or selling stocks when good or bad news comes out will produce abnormal returns. Those who explore this aspect of the market are said to engage in event studies. Eugene Fama surveyed the considerable body of empirical work in this area to determine whether stock prices do indeed respond efficiently to information. The events included such announcements as earnings surprises, stock splits, dividend actions, mergers, new exchange listings, and initial public offerings. Fama found that apparent underreaction to information is about as common as overreaction, and post-event continuation of abnormal returns is as frequent as post-event reversals. He also showed that many of the return anomalies tend to disappear when exposed to different models for expected normal returns, different methods to adjust for risk, and when different statistical approaches are used to measure them. He concluded that most of the anomalies discovered by researchers can reasonably be attributed to chance. Certainly, they do not appear to offer investors a dependable way to earn abnormal returns. Why the aim is so bad. It should be obvious by now that any truly repetitive and exploitable pattern that can be discovered in the stock market and be arbitraged away will self-destruct. At one time, there may have been a truly dependable and exploitable January effect in which the stock market, especially stocks of small companies, generated extraordinary returns during the first 5 days of January, what would investors do with the finding? Easy. They would buy on the last day of December and sell on January 5th. But then investors would find that the market rallied on the last day of December, and so they would need to begin to buy on the next to last day of December. And because there is so much profit-taking on January 5th, investors would have to sell on January 4th to take advantage of this effect. Thus, to beat the gun, investors will have to be buying earlier and earlier in December and selling earlier and earlier in January, so that eventually the pattern would self-destruct. Indeed, the January effect became undependable after it received considerable publicity. As one wag put it, the January effect sometimes occurs on the previous Thanksgiving week. Similarly, suppose there's a general tendency for stock prices to underreact to certain new events, leading to abnormal returns to investors who exploit the lack of full, immediate adjustment, a finding publicized by the behavioralists Werner de Bont and Richard Thaler, and researchers John Campbell, Andrew M. Lowe, and A. Craig McKinley. Quantitative investment managers will then develop strategies in an attempt to exploit the pattern. Indeed, the more potentially profitable a discoverable pattern is, the less likely it is to survive. Moreover, many of the predictable patterns that have been discovered may simply be the result of data mining. The ease of experimenting with financial data makes it quite likely that investigators will find some seemingly significant but wholly spurious correlation between financial variables or among financial and non-financial data sets. Given enough time and massaging of data series, it is possible to tease almost any pattern out of most data sets. Moreover, the published literature is likely to be biased in favor of reporting such results. Significant effects are likely to be published in professional journals, while negative results or boring confirmations of previous findings are relegated to the file drawer or discarded. Data mining problems are unique to non-experimental sciences, such as financial economics, which rely on statistical analysis for their insights and cannot test hypotheses by running repeated controlled experiments. Pot shots that get close but still miss the target. Ever mindful that they need either theories or strategies to nail down tenure or bonuses, both academics and analysts have come up with slightly more accurate shots aimed at destroying the essential unpredictability of the stock market. These can be grouped into 3 categories: those that seek to nail down the market's direction, those that purport to find superior long-run market returns, and those that attempt to single out the most profitable stocks. Economists refer to the first 2 categories as time series strategies and include under these the trend is your friend, the dividend jackpot approach, the initial PE predictor, and the back we go again strategy. Theories in the 3rd category come under the aegis of cross-sectional studies and include the smaller is better effect and the claim that value will win. While all of these strategies have some merit, some more than others, not one is able consistently to penetrate the veil of unpredictability cloaking the market. The trend is your friend, otherwise known as short-term momentum. The original empirical work supporting the notion of randomness in stock prices supported the view that the stock market has no memory. The way a stock price behaved in the past is not useful in divining how it will behave in the future. Just because a stock has been rising doesn't mean it will keep on rising. Several later studies have been inconsistent with this pure random walk model. They show that there is some degree of momentum in the stock market and that price changes measured over short periods of time do tend to persist. For example, the researchers Lowe and McKinley found that for 2 decades broad portfolio stock returns for weekly and monthly holding periods showed positive serial correlation. In other words, a positive return in 1 week is more likely than not to be followed by a positive return in the next week. Moreover, Lowe and others have suggested that some of the stock price patterns used by so-called technical analysts may actually have some modest predictive power. Economists and psychologists in the field of behavioral finance find such short-run momentum to be consistent with psychological feedback mechanisms. Individuals see a stock price rising and are drawn into the market in a kind of bandwagon effect. As mentioned in chapters 4 and 10, Robert Shiller described the rise in the U.S. stock market during the late 1990s as the result of psychological contagion leading to irrational exuberance. As behavioral finance became more prominent, momentum, as opposed to randomness, seemed entirely reasonable to many investigators. I believe there are two factors that should prevent us from interpreting the empirical results reported above as an indication that markets are inefficient. While the stock market may not be a perfect random walk, it's important to distinguish statistical significance from economic significance. The statistical dependencies giving rise to momentum, in fact, are extremely small and are not likely to permit investors to realize excess returns. Anyone who pays transactions costs is unlikely to find a trading strategy based on momentum that will beat a buy-and-hold strategy. Indeed, work by another behavioral economist, Terence Odine, suggested that momentum investors do not realize excess returns. Quite the opposite. A sample of such investors indicates that these traders did far worse than buy-and-hold investors even during a period where there was clear statistical evidence of positive momentum. We also need to ask whether such patterns of serial correlation are consistent. Momentum strategies, buying stocks that appear to be in an uptrend and/or displaying relative strength, appear to produce positive relative returns during some periods, but highly negative ones during others. It's far from clear that any stock price patterns are useful for investors in fashioning an investment strategy that will dependably earn excess returns. William Schwert raises the interesting point that since many predictable patterns seem to disappear after they are published in the finance literature, they may simply reflect a bias in the data samples selected and the normal tendency of researchers to focus on results that challenge perceived wisdom. Alternatively, perhaps practitioners learn quickly about any true predictable pattern and exploit it to such an extent that it becomes no longer profitable. The dividend jackpot approach. This technique for outguessing the market rests on the logical assumption that if stocks in general are providing above-average dividend yields, then the total future returns investors receive will be relatively generous. Two academic studies, one by Eugene Fama and Kenneth French, and the other by John Campbell and Robert Shiller, concluded that one can indeed hit the jackpot with such an approach, thereby negating the randomness of the market. Depending on the forecast horizon involved, as much as 40% of the variability in future market returns can be predicted on the basis of the initial dividend yield of the market as a whole. A diagram was produced that measured the dividend yield of the broad U.S. stock market, in this case the Standard & Poor's 500 stock index, each quarter since 1926, and then calculating the market's subsequent 10-year total return through the year 2005. The observations were then divided into deciles, depending upon the level of the initial dividend yield. In general, the exhibit shows that investors have earned higher total rates of return from the stock market when the initial dividend yield of the market portfolio was relatively high, and relatively low future rates of return when stocks were purchased at low dividend yields. These findings are not necessarily inconsistent with efficiency. Dividend yields of stock tend to be high when interest rates are high, and they tend to be low when interest rates are low. Consequently, the ability of initial yields to predict returns may simply reflect the adjustment of the stock market to general economic conditions. Moreover, the dividend behavior of U.S. corporations may have changed over time. Companies in the 21st century may be more likely to institute a share repurchase program than to increase their dividends. Thus, dividend yield may not be as meaningful as in the past. Further, it's worth pointing out that dividend yields were unusually low, and the stock market appeared irrationally exuberant at the start of 1995, when the Dow Jones Industrial Average was selling at the 5,000 level. The Dow went on to peak near 11,000, and even after the punishing decline in stock prices during the early 2000s, the return from the market portfolio was still generous. Indeed, even from the time of Federal Reserve Chairman Alan Greenspan's famous irrational exuberance speech in December 1996, returns from the market portfolio were approximately 8% during the next decade. Finally, note that this phenomenon does not work consistently with individual stocks. Investors who simply purchase a portfolio of individual stocks with the highest dividend yields in the market will not earn a particularly high rate of return. The initial P/E predictor. The same kind of predictability for the market as a whole, as was demonstrated for dividends, has been shown for the price-earnings ratio of the market as a whole. The data are presented in a decile analysis similar to that described for dividend yields. Investors have tended to earn larger future returns when purchasing stocks at relatively low price-earnings multiples. Campbell and Schiller report that over 40% of the variability in long-horizon returns can be predicted on the basis of the initial market P/E. They conclude that equity returns were predictable in the past to a considerable extent. There's also some evidence that individual stocks with low P/Es relative to the market may produce higher rates of return. 2 points should be made about these findings, which suggest a great deal of forecastability of stock prices. First, such findings may be perfectly consistent with an efficient market view of security price determination. For example, stock prices are low relative to earnings when interest rates are high, and thus required returns for all financial assets are high. P/Es were also very low during the early 1980s, when U.S. government bonds had double-digit yields. Moreover, blind reliance on these patterns can lead to large investment mistakes. In 1992, the P/E for the market was unusually high, well above 20. The 10-year average annual rate of return was forecast to be only 5%. In fact, the 10-year rate of return for the S&P 500 from 1992 through 2001 was in the double digits. I have a colleague who switched his retirement plan entirely into bonds during the early 1990s because P/E ratios were so high. Over the next 10 years, he was very sorry for his decision and far less certain that it's easy to predict stock returns. The back-we-go-again strategy, otherwise known as long-run return reversals. Buying stocks that performed poorly during the past 3 years or so is likely to give you above-average returns over the next 3 years. This is the finding of research carried out by Eugene Fama and Kenneth French, as well as by James Paterba and Lawrence Summers, and by Werner DeBont and Richard Thaler. In research jargon, they say that although stock returns over short horizons, such as a week or a month, may be positively correlated, stock returns over longer horizons, such as 2 years or more, display negative serial correlation. Thus, a contrarian investment strategy, that is, buying those stocks that have had a relatively poor recent performance, might be expected to outperform a strategy of buying those stocks that recently produced superior returns. The implicit advice to investors is that the market often overreacts, as the behavioralists argue, and therefore it's wise to shun fashionable stocks and concentrate on those out of favor. Of all the predictable patterns that have been uncovered or alleged, this one strikes me not only as one of the most believable, but also as potentially most beneficial for investors. Certainly, the evidence in Part 1 of this book shows clearly that fads and fashions can play a role in stock pricing. At times, large capitalization blue-chip stocks have been all the rage. In other periods, internet stocks or biotechnology securities have caught investors' fancies. No matter what the fad, all carried stock prices to extremes and led to severe losses for investors who purchased at the apex. If investors could avoid buying at the top of an unwarranted bubble, serious investment mistakes could be avoided. Similarly, if those stocks that were overly popular turn out to be poor investments, perhaps the stocks that have recently been shunned by investors, the ugly ducklings of the investment world, will eventually come out from under their cloud, particularly when such a contrarian approach is wedded to a fundamental value approach. To avoid buying stocks simply because they're unpopular, investors may well benefit from this kind of strategy. The behavioral explanation for such reversals in realized stock returns suggests the dominance of castle-in-the-air builders among investment decision-makers. If stock prices were always influenced by fads and fashions that tended to arise and then decay over time, such reversals in security returns would be expected. Hence, many investigators have concluded that the evidence concerning reversals in returns is inconsistent with the efficient market hypothesis. Well, maybe yes, but maybe no. There are both logical and statistical reasons to continue to stand by the theory of efficient markets. Return reversals over different time periods are often rooted in solid economic facts rather than psychological swings. The volatility of interest rates constitutes a prime economic influence on share prices. Because bonds, the front-line reflectors of interest rate direction, compete with stocks for the investor's dollars, one should logically expect systematic relationships between interest rates and stock prices. Specifically, when interest rates go up, share prices should fall, other things being the same, so as to provide larger expected stock returns in the future. Only if this happens will stocks be competitive with higher-yielding bonds. Similarly, when interest rates fall, stocks should tend to rise because they can promise a lower total return and still be competitive with bonds. It's easy to see how fluctuations in interest rates can produce return reversals in stocks. Suppose interest rates go up. This may cause both bond and stock prices to fall, and often produces low or negative rates of return over the time periods when the interest rates rose. Suppose now that interest rates fall back to their original level. This may cause bond and stock prices to rise and tends to produce very high returns for stockholders. Thus, over a cycle of interest rate fluctuations, we may see relatively large stock returns following low stock returns, that is, return reversals. The point is that such return reversals need not be due to fads that decay over time. They can also result from the very logical and efficient reaction of stock market participants to fluctuations in interest rates. Obviously, in any given period there are many influences on stock prices apart from interest rates, so one should not expect to find a perfect correspondence between movements of interest rates and stock prices. Nevertheless, the tendency of interest rates to influence stock prices could account for return reversals, and such a relationship is perfectly consistent with the existence of efficient markets. Statistically, there are also reasons to doubt the robustness of this finding concerning return reversals. Correlations of returns over time were much lower in the first half of the 20th century than in the second. Thus, the use of simple contrarian investment strategies is no guarantee of success. And even if fads are partially responsible for some return reversals, as when a particular group of stocks comes in and out of favor, fads don't occur all the time. Finally, it may not be possible to profit from the tendency for individual stocks to exhibit return reversals. Although such reversals may be statistically significant, they may only represent reversion to the mean rather than predictable opportunities to earn above-average returns. Zuzana Fluck, Richard Quant, and I simulated an investment strategy of buying stocks that had experienced relatively poor recent 2- or 3-year performance. We found that those stocks did enjoy improved returns in the next period of time, but they recovered only to the average stock market performance. Thus, there was a statistically strong pattern of return reversal, but not one that you could profit from. And even if the recent losers did produce extraordinary subsequent returns, this does not imply that stock prices systematically overshoot their appropriate levels. Stocks that have gone down sharply after some unfavorable business reversals exhibit heightened uncertainty and volatility, and therefore greater risk for investors. Because investors require higher returns for bearing greater risk, a finding that future returns in these stocks are relatively generous is consistent with the efficient functioning of markets. Moreover, my belief that prices do not systematically overreact is reinforced by the fact that we do not find significant price reversals after sharp run-ups in prices. So what's an investor to do? As the careful listener knows, I believe that the stock market is fundamentally logical. I also recognize that the market does sometimes get carried away with popular fads and that pessimism can also be overdone. Thus, value investors operating on the firm foundation theory will often find that stocks that have produced poor recent returns may provide generous returns in the future. Knowing that careful statistical work supports this tendency, at least to some extent, should give investors an additional measure of comfort in undertaking a contrarian investment strategy coupled with a firm foundation approach. But remember that the statistical relationship is a loose one, and that some unpopular stocks may be justly unpopular and undoubtedly somewhat riskier. Certainly, some companies that have been going downhill may continue to go down the tubes, as investors in Enron and WorldCom learned painfully during 2002. The relationships are sufficiently loose and uncertain that one should be very wary of expecting sure success from any simple contrarian strategy. The smaller is better effect. Probably one of the strongest patterns that investigators have found in stock returns is the tendency over long periods of time for small company stocks to generate larger returns than those of large company stocks. Since 1926, small company stocks in the United States have produced rates of return over 1.5 percentage points larger than the returns from large stocks. The work of Fama and French, who divided stocks into deciles according to their size, found that decile 1, the 10% of stocks with the smallest total capitalization — the total capitalization is one way to measure a company's size, it's simply the price per share multiplied by the number of shares outstanding — produced the largest rates of return, whereas decile 10, the largest stocks in terms of market capitalization, produced the smallest rate of return. Moreover, small firms tended to outperform larger firms with the same beta levels. Nevertheless, we need to remember that small stocks may be riskier than larger stocks and deserve to give investors a higher rate of return. Thus, even if the small firm effect were to persist in the future, such a finding would not violate market efficiency. A finding that small company stocks outperform the stocks of larger companies on a risk-adjusted basis depends upon how one measures risk. We've seen that beta, the risk measure typically used in the studies that have found excess returns from small firms, may be an incomplete measure of risk. It's therefore impossible to distinguish whether the abnormal returns are truly the result of inefficiencies or whether they result from inadequacies in our measure of risk. The higher returns for smaller companies may simply be the requisite reward owed to investors for assuring a greater risk of disappointment in the investment returns they expect. Moreover, the small firm effect found that some studies may simply flow from what is called survivorship bias. Today's list of companies includes only small firms that have survived, not the small firms that later went bankrupt. Finally, the dependability of the small firm effects continuing is open to considerable question. While smaller stocks did very well during the first 6 years of the 2000s, there was little to gain from holding smaller stocks during the 1990s. Clearly, buying a portfolio of small firms is hardly a surefire technique to enable an investor to earn abnormally high, risk-adjusted returns. The value will win record. In 1934, David L. Dodd and Benjamin Graham published a manifesto for investors that has attracted strong adherents, including the legendary Warren Buffett, to this day. They basically argued that value always wins over time. To find value, investors should look for stocks with low price-earning ratios and low prices relative to their book values. In this scenario, value is based on current realities rather than on projections of future growth. The resulting theory is consistent with the views of behavioralists such as Kahneman and Thaler, that investors tend to be overconfident of their ability to project high earnings growth and thus overpay for growth stocks. Stocks with low price-earnings multiples outperform those with high multiples. I have considerable intellectual sympathy with this approach. One of my cardinal rules of stock selection is to look for companies with good growth prospects that have yet to be discovered by the stock market and thus are selling at relatively low earnings multiples. This approach is often described as GARP, growth at a reasonable price. I've warned investors repeatedly about the dangers of very high multiple stocks that are currently fashionable. Particularly because earnings growth is so hard to forecast, it's far better to be in low multiple stocks. If growth does materialize, both the earnings and the earnings multiple will likely increase, giving the investor a double benefit. Buying a high multiple stock whose earnings growth fails to materialize subjects investors to a double whammy. Both the earnings and the multiple can fall. There's some evidence that a portfolio of stocks with relatively low earnings multiples, as well as low multiples of cash flow and of sales, produces above-average rates of return even after adjustment for risk. This strategy was tested by Sanjoy Basu in the late 1970s and has been confirmed by several researchers since then. The PE effect appears to vary over time. It's not dependable over every investment period. And even if it does persist on average over a long period of time, one can never be sure whether the excess returns are due to increased risk or to market abnormalities. The studies that have documented abnormal returns have used beta to measure risk. To the extent that beta is a far from perfect risk measure, one cannot claim that the low PE pattern indicates a market inefficiency. And don't forget that low PEs are often justified. Companies on the verge of some financial disaster will frequently sell at very low multiples of reported earnings. The low multiples might reflect not value, but a profound concern about the viability of the companies. And low multiples could also reflect investor concern about the accounting quality of the repeated earnings. Stocks that sell at low multiples of their book values tend to produce higher subsequent returns. Another predictable pattern of return is the relationship between the ratio of a stock's price to its book value, the value of the company's assets as recorded on its books, and its later return. Stocks that sell at low ratios of price to book value tend to produce higher future returns. This pattern appears to hold for both U.S. and many foreign stock markets, as has been shown by Fama and French. Behavioralists argue that such results raise questions about the efficiency of the market if one accepts beta as the appropriate measure of risk. But these findings do not necessarily imply inefficiency. Price-to-book value ratios, or PBV, could reflect another risk factor that's priced into the market. Companies in some degree of financial distress are likely to sell at low prices relative to book values. Fama and French argue that a three-factor risk model, including PBV and size, as well as beta as measures of risk, is the appropriate benchmark against which any supposed inefficiencies should be measured. But does value really trump growth on a consistent basis? We also must remember that the results of published studies, even those done over decades, may still be time-dependent, and ask whether the return patterns of academic studies can actually be generated with real money. William Schwert points out that the investment firm of Dimensional Fund Advisors actually began a mutual fund that selected value stocks quantitatively according to the FAMA French criteria. The excess risk-adjusted return of such a portfolio was a negative 0.2% per month over much of the 1990s, using beta as the measure of risk. This is consistent with the results from actively managed value mutual funds. To be fair, however, it should be noted that value funds did very well during the first 6 years of the 2000s. Why even close shots miss? Another market pathology often cited by behavioralists as clear evidence that markets are not efficient describes the turn-of-the-century Internet bubble examined in Chapter 4. Surely, the remarkable market values assigned to Internet and related companies seem totally inconsistent with rational valuation. I sympathize with behavioralists in this instance, and in reviewing Robert Shiller's irrational exuberance, I agreed that it was in the high-tech sector of the market that his thesis could most plausibly be supported. But even here, when we know ex post, after the collapse, that major errors were made, there were certainly no clear ex ante, while it was going on, arbitrage opportunities available to rational investors. Convinced as I was that a bubble was inflating, I did not take the risk of selling Internet stock short, because no one could know how many greater fools would come around and push prices even higher. Equity valuations rest on uncertain future forecasts. Even if all market participants rationally price common stocks as the present value of all expected future cash flows, it's still possible for clear excesses to develop. We know, with the benefit of hindsight, that the outlandish claims regarding the growth of the Internet and the related telecommunication structure needed to support it were unsupportable. We know now that projections for the rates of growth and the stability and duration of those growth rates for new economy companies were unsustainable. But it was the sharp-penciled professional investors who argued that the valuations of high-tech companies were proper. It was a top security analyst from the venerable Wall Street firm of Morgan Stanley who became the doyen of the Internet by recommending net stocks to the firm's clients. And it was the professional pension fund and mutual fund managers who overweighted their portfolios with high-tech stocks. While it is clear in retrospect that such professionals were egregiously wrong, there was certainly no obvious arbitrage opportunity available. One could disagree with the projected growth rates of security analysts, but who could be absolutely sure, with the use of the Internet then doubling every several months, that the extraordinary growth rates that could justify stock valuations were impossible? After all, even Alan Greenspan, then chairman of the Federal Reserve Board, was singing the praises of the new economy. Nothing is ever as clear in prospect as it is in retrospect. And even when clear mispricing arbitrage opportunities seemed to have existed, there was no way to exploit them. Recall the illustration of 3Com spinning off 5% of the shares of Palm Pilot stock it owned, announcing its intention to spin off the remaining 95% later. Irrational exuberance pushed the price of Palm stock so high that if you bought 3Com, which still owned 95% of Palm, you could have effectively bought Palm stock for less than the price at which it was selling in the market. The 95% of Palm that 3Com owned was worth $25 billion more than the total market capitalization of 3Com at going market prices. Here was an obvious case of mispricing and an apparently profitable arbitrage opportunity. The clear arbitrage, borrow Palm Pilot stock and sell it short and buy 3Com, could not be undertaken. Not enough Palm stock was outstanding to make it possible to borrow the stock. The anomaly disappeared once 3Com spun off more of Palm stock. Moreover, the potential profits from name or ticker symbol confusion described in Chapter 4 were extremely small relative to the transactions costs required to exploit them. Thus, none of these illustrations should shake our faith in the long-run efficiency of our stock markets. Perhaps the more important anomaly today is why so many investors buy high-expense, actively managed mutual funds instead of low-cost index funds. And the winner is... It's now time to see how the findings just discussed actually perform in practice. If predictable patterns are present, and if mispricings frequently exist, then professional investment managers clearly ought to be able to use them to beat a simple index fund. So let's take a careful look at the results racked up by professionally managed portfolios. The performance of professional investors. For me, the most convincing tests of market efficiency are direct tests of the ability of professional fund managers to outperform the market as a whole. Surely, if market prices were determined by irrational investors and systematically deviated from rational estimates of the present value of corporations, and if it was easy to spot predictable patterns in security returns or anomalous security prices, then professional fund managers should be able to beat the market. Direct tests of the actual performance of professionals, who are richly incentivized to outperform the market, should represent the most compelling evidence of market efficiency. A remarkably large body of evidence suggests that professional investment managers are not able to outperform index funds that simply buy and hold the broad stock market portfolio. We covered much of this work in Chapter 8. For the 20 years ending December 31, 2005, the average actively managed large capitalization mutual fund underperformed the Standard & Poor's 500 large cap index by almost 1.5 percentage points per year. While the index may not win in every single year, decade after decade, 2/3 or more of professionally managed funds are beaten by index funds. Similar results can be shown for different time periods and using different indexes for comparison. Results are also the same for international markets as well as for different asset classes such as bonds and real estate investment trusts. To be sure, there are always hot funds that beat the market in some particular period of time, and some academic studies have claimed that mutual fund returns are predictable. They claim that funds that have been superior or inferior performers in one period predictably perform better or worse in a subsequent period, at least over the near term. Thus, investors could earn significantly better returns by purchasing recently good-performing funds, apparently contradicting the efficient market hypothesis. Naturally, I have followed this work with great interest, and I'm convinced that many studies have been flawed by the phenomenon of survivorship bias, that is, including in their studies only the successful funds that survived over a long period of time, while excluding from the analysis all the unsuccessful funds that fell by the wayside. Commonly used data sets of mutual fund returns, such as those available from the Morningstar service, typically show the past records of all funds currently in existence. Clearly, today's investors are not interested in the records of funds that no longer exist. This creates the possibility of significant biases in the return figures calculated from most of the available data sets. Mutual funds that are unsuccessful usually do not survive. You're not alone in being reluctant to buy a mutual fund with a poor record. Mutual fund complexes, those with large numbers of funds, typically allow such a fund to suffer a painless death by merging it into a more successful fund in the complex, thereby burying the bad fund's record. Thus, there will be a tendency for only the more successful funds to survive, and measures of the returns of such funds will tend to overstate the success of mutual fund management. Moreover, it may appear that high returns will tend to persist. The problem for investors is that at the beginning of any period they can't be sure which funds will be successful and survive. Another little-known factor in the behavior of mutual fund management companies also leads to the conclusion that survivorship bias may be quite severe. A number of mutual fund management complexes employ the practice of starting incubator funds. A complex may start 10 small new equity funds with different in-house managers and wait to see which ones are successful. Suppose, after a few years, only 3 funds produce total returns better than the broad market averages. The complex begins to market those successful funds aggressively, dropping the other 7 and burying their records. The full records from inception of the successful funds will be the only ones to appear in the usual publications of mutual fund returns. To get a handle on the possible magnitude of this bias, I obtained from Lipper Analytic Services, a company that publishes information on mutual fund returns, more than 20 years of data on the records of all mutual funds that were available to the public each year, whether or not they survived. What I found was that surviving funds earned returns that were 1.5 percentage points greater than the returns for all mutual funds that were in existence each year. The Vanguard group of investment companies plotted the data for a period of over 35 years. When you read press stories of how well mutual funds do, it's likely you're seeing only the records of surviving funds, and no one knows in advance which the surviving funds will be. When all mutual funds sold to the public are considered, the original thesis propounded by the first edition of A Random Walk Down Wall Street in 1973 holds up remarkably well. Over the entire 35-year period since the first edition of this book, about 2/3 of the funds proved inferior to the market as a whole. The same result also holds for professional pension fund managers and even for highly compensated hedge fund managers. Most equity investment managers could have substantially improved their performance by casting their lot with the efficient market theory and not trying to outguess the market. Indeed, if the S&P index were an athlete, we'd probably be testing it for steroids. We see that managed funds are regularly outperformed by a broad index fund with equivalent risk. Moreover, as was demonstrated in Chapter 8, those funds that do appear to produce excess returns in one period are not likely to do so in the next. There's no dependable persistence in performance when one considers all mutual funds, not simply the survivors. Recall that it was the hot funds of the late 1990s that failed so miserably in the early 2000s. Over the long run, the results are even more devastating to active managers. One can count on the fingers of one hand the number of professional portfolio managers who've managed to beat the market by any significant amount. And you can be sure the non-surviving funds did even worse. The record of professionals does not suggest that sufficient predictability exists in the stock market or that there are enough recognizable irrationalities to produce exploitable opportunities to earn excess returns over the market average.
This ends Disc